Hey everyone, welcome back to Corporate Decoder, the place where we try to make sense of all the corporate money talk. And well, today we're diving into Upwork Incorporated's latest annual report. And let me tell you, it is a big one packed with numbers, strategies, and a healthy dose of risk. You know, the kind of stuff that makes your eyes glaze over unless you've got us to decode it for you. So if you appreciate cutting through the jargon to get to the golden nuggets of information, make sure you are subscribed. And hey, join our Discord community linked in the description below to chat with fellow corporate detectives. Alright, let's jump right in and see where Upwork stands as of the 31st of December 2025. Their total assets are hovering around $1.3 billion, a decent number, and it is mostly made up of cash equivalents and marketable securities, which is always good to see around $378 million in marketable securities and $294 million in cash and equivalents. Their total liabilities are around $669 million. Interestingly, they have $359 million in debt classified as current, meaning it is due within the next year. This is a significant chunk, so we'll need to keep an eye on how they manage that maturity. Now let's talk about money coming in. For the year ended the 31st of December 2025, Upwork brought in $787.8 million in total revenue. That is a nice increase of 2% compared to the previous year, which was $769.3 million. The majority of that revenue, 87% to be exact, comes from their marketplace. Enterprise revenue made up the remaining 13%, but it actually decreased slightly by 2% to $104.9 million. This number, the marketplace take rate, is quite key. It is how much money Upwork makes off of every dollar spent on its marketplace. In 2025, it jumped to 18.7% from 18.0% the year before. This rise is a good sign, suggesting they are getting better at monetizing the activity on their platform, largely thanks to their advertising product. However, active clients actually decreased by 6%, which is a bit of a red flag. But here is where it gets interesting. GSV per active client increased by 7%. This means the clients who are still on the platform are spending more. So while they might be losing some smaller clients, the ones that remain are more valuable. On the profit side, things are a bit mixed. Net income in 2025 was $115.4 million. This is a significant drop of 46% from 2024, where they reported a net income of $15.6 million. Now, before you panic, the big reason for this drop is a one-time non-cash income tax benefit of $140.3 million that happened in 2024. This means they had a really good year in 2024, partly due to accounting magic. Adjusted EBITDA, however, which is a measure of operational profitability, increased by a strong 35% to $225.6 million, a good sign that the core business is performing well despite the dip in net income due to that tax item. Let's look at how they are spending money to build for the future. Research and development expenses decreased by 11% to $185.5 million. This is largely due to cost-saving measures and workforce reductions. They clearly are trying to be more efficient here. Sales and marketing expenses also saw a significant drop of 23%, coming in at $143.4 million. This is driven by streamlining their sales and marketing teams and cutting back on advertising. They seem to be focusing on cost optimization across the board. But here is an interesting shift. General and administrative expenses actually increased by 14% to $146.6 million. This increase is mainly due to higher personnel costs and more spending on consultants. This could be related to the recent acquisitions and integration efforts. They are also setting aside a bit more money for things to go wrong, like fraud or bad debt. The provision for transaction losses increased by 21% to $8.1 million. Not a huge number, but it shows they are being cautious about potential financial risks. Now let's talk about growth through buying other companies. In 2025, they acquired Bubdy BV for $20.4 million and Accession Inc. for $40.8 million. These acquisitions are all about beefing up their enterprise solutions, particularly with new workforce management and employer of record capabilities. These deals added significant goodwill to their balance sheet, around $29.4 million in goodwill in 2025 from these acquisitions alone. This shows a clear strategy to expand their enterprise offerings. And then there is the tax situation. In 2025, they recorded an income tax expense of $37.8 million. This is a big jump from the tax benefit they saw in 2024. A key reason for this change is the establishment of a valuation allowance related to certain state deferred tax assets. Basically, they are setting aside money because they are not sure they will be able to use certain tax benefits in the future. This is a notable point of caution. Now for the fun part, the risks, Upwork is upfront about the challenges they face. They're heavily reliant on growing and keeping their talent and client community. If that doesn't happen, their business suffers. Managing growth effectively is also a big concern, and they acknowledge that past growth doesn't guarantee future performance. Changes to their business strategy offerings and pricing models are a constant factor, and they admit these changes can sometimes have unintended negative effects like customer dissatisfaction. They also mention the emergence of AI tools as a competitive factor, potentially affecting traditional talent tasks. Security is another big one, with risks of hacks and data breaches always looming. And of course, they're dealing with the ever-changing landscape of government regulations, especially around worker classification. This could significantly impact how they and their clients operate. On the property front, they're pretty straightforward. They lease their corporate headquarters in Palo Alto and believe their current facilities are sufficient. Looking at their debt, they have $361 million in convertible senior notes due in August 2026. This is a significant amount of debt, and it is classified as a current liability because it is coming due soon. They are exploring refinancing options, which is a pretty standard move when debt is on the horizon. Now let's cut through the corporate speak and talk about what this all means. Upwork is strategically shifting its focus towards larger enterprise clients, a move clearly demonstrated by their recent acquisitions and the introduction of Lifted. They're getting better at getting their existing clients to spend more, which is a positive sign of engagement. However, the decline in active clients and the slight dip in enterprise revenue raise questions about their growth engine, particularly as they focus on integrating new entities. The increase in general and administrative expenses, coupled with higher transaction loss provisions, suggest they are investing in growth and managing potential risks, but also incurring costs. The tax situation with that new valuation allowance for state-deferred tax assets is a bit concerning and definitely something to watch. So what is the overall picture? Upwork is navigating a complex market by focusing on monetization and strategic acquisitions for its enterprise segment. The company is demonstrating operational efficiency with lower R&D and sales marketing costs, but is also facing the natural challenges of growth and integration. The near-term debt maturity is a point of attention, but their strong cash position and focus on refinancing should help. It seems like they are betting heavily on enterprise clients to drive future growth and are willing to invest and make strategic moves to get there. It is a calculated bet, and it will be interesting to see how it plays out. Alright, that is our deep dive into Upwork's latest financial disclosures. What is your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more corporate decoding. Don't forget to check out the Discord link in the description. Thanks for watching, and we'll see you in the next one.